Hello and welcome to the Stansberry Investor Hour. I'm Dan Ferris. I'm the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today we talk with Bryan Beach, editor of our Stansberry Venture Value newsletter.
And today Corey and I will talk about the Republican presidential debate, Jackson Hole, Wyoming, and long-term investing.
And remember, if you want to let us know what's on your mind, email us at feedback@investorhour.com.
That and more right now on the Stansberry Investor Hour. Well, I have to ask you straight up. I mean, did you watch the debate? Do you care at all about the Republican presidential debate?
I do care. I did not watch any of it for two reasons. One, it's very early on in this whole process, and politics is just there's never none of it, so there's plenty of time to get involved in it further. And second, I've been away for a couple days and trying to tune out a little bit, but not tuning out enough to skip our episode here. So yes and no. I read a couple things on the debate, and without Trump there, though, it's kind of who's still the leader by in polling by a wide margin, which people still seem to not want to acknowledge. Acknowledge that that's the obvious elephant in the room. I know they talked about him a lot, but without him there, it's a little, I don't know. It seems like having a playoff game with one team or something in a big sporting event.
Yeah. I mean, as far as the actual outcome of the election goes, I mean, I agree with you. It's early on. Who cares? I'm not even thinking about it. And to me, I don't think it matters who gets elected anyway. I honestly don't. But I will say this. If Vivek Ramaswamy had a snowball's chance in hell of getting elected, he said when he wasn't being shouted down that he wanted to dismantle the administrative state. And I think, in my view, that is the only legitimate primary focus of any presidential candidate at this point in our history. It's out of control. It costs too much. It makes life much harder for people who can afford it least. And it's just gone too far. It's very obvious that we've created this enormous central power, and that everybody with connections and money wants to get their hands on it and serve themselves and their own interest with it. And way too many people have succeeded at that. And it's kind of a mess. So if he actually got elected, there might be a chance that he would leave office after 4 years with a smaller government, which I think nobody ever does. I don't know if that's ever happened. Certainly hasn't happened in my lifetime.
Yeah, I can't remember it.
Yeah. So, that's my little fantasy. I know it's never going to come true. I don't worry about it. I don't think about it too much. But I just don't like any politicians. And when he says these things, I think, oh, that's not bad. It's sort of like Thomas Massey. He says things, and I automatically cancel or block them all in my Twitter feed because I just don't want it in my feed. But he says things, I think, oh, I should block him. It's always a knee-jerk block with any elected representative, but not him. So we'll see. I have like 1% hope or 0.1% hope of this sort of thing happening. Otherwise, not sure I care about.
Well, yeah, I mean, he was the guy that seemed like everybody wanted to attack from what I heard and read. So that should tell you something, that they're a little, usually how these debates go, in the past, you've gang up on one guy who kind of has, or girl who has a popular message, and try to get them out of the race as early as possible so they don't, catch a heater like Trump did, right? And go up the polls and win the primary when nobody was expecting. I did find it interesting. I did watch a clip of like the first 5 minutes or the first 30 seconds about what the first question was about that song, The Rich Men of Richmond, which has been going viral all over the place for the guy, honestly, I forget his name. I'm sorry, but in the woods in front of a tree hunting stand and playing his song. And I do think, the fact that was the first thing asked on the debate, I don't know, that just tells you about the climate that we're going to be in the next year or two as this continues. I mean, this is real this is real stuff when inflation is being inserted into the race for president here, and so politics and the markets are going to be intertwined one way or another. They always are to some extent, but with this political cycle, I don't. It's very clear that there's going to be some economic impact from it, and it's still a polarized world. And I don't know. Some weird things are happening with in politics again right now, and so you got, of course, we just said, yeah, the Trump's got a mugshot now that he's now selling on T-shirts. So it's like, what is going on here? It's hard to make sense of it and know what's going to come next. But that I don't know. The politics is going to be volatile over the next year or two. Is the short thought there.
Yeah, and as far as, if you're an investor looking at this, as usual, like most elections, you don't really care. And I don't think this one is terribly different. But I do think that if we wind up with Democrats in office again, we would probably get more green energy funding than if Republicans wind up in office. And either way, I don't think either one of them can turn oil into a bad bet, because the more they do to, push green energy and inhibit the creation of new fossil fuel supply, the better the fossil fuel trade gets. And, and then, you look at things like copper as well. Um, the Pebble mine in Alaska has been killed by the Biden administration at this point. And they say it's a terrible place for a mine because the salmon population and all this stuff. And everybody is like that all around the world. I mean, it's even difficult in Chile and Peru, like the two biggest copper producing countries. So like the worse that governments get with all this stuff, the better the trade gets for investors. And I think that'll continue. We'll see. Who like I remember when Trump got elected, and I was sitting there watching Mexican peso futures because I thought being short Mexican peso was a great trade, and it was, and just being short stocks, and like the futures overnight just caved in, and then by the next morning, by market open, it was all over. That was it. Best crisis ever. Done. And then, it was off to the races because of all the tax cuts and everything that people liked about him. Um, don't think we're going to see anything like that this time.
Yeah, I don't.
It'll be interesting. But I got to ask you about something else, though. I think we're going to have to let people in sort of behind the curtain here. As we record, Jerome Powell is speaking in Jackson Hole, and so far, the market actually seems to like it. And what I wonder is, I've been thinking about this a lot lately, and as you know, I've written about it in a recent Stansberry Digest. Like, what? I don't know. I can't let go of my higher for longer viewpoint, and I don't see. I don't have a transcript. I don't know what he's saying, but I just don't think that things are going to be very different. I don't see any big changes in what's happening with the Federal Reserve. The most different thing I see them doing is leaving rates unchanged here and there, but I just they overshoot everything. They overshot their 2% target from the bottom to the upside. I mean, 9% on the CPI, 5% on core PCE. And I think they overshoot probably to the downside. I think at some point they do cause a recession, by pushing rates higher and higher, or, keeping them higher for longer and longer. But right now, see, as we speak, the market is complacent, doesn't seem to care. NASDAQ up 1%, whatever.
Yeah,
So I
it
don't know.
looks like more of the status quo going into this as far as Fed policy. It looks like he's saying inflation's too high, and we are prepared to raise rates further, which means not that we're definitely going to raise rates further, but that they at the same time you have to remember that they've already kind of penciled in another 25 basis point hike the rest of the year. So I think people are looking at, well, them to maybe pause the rate hiking again, then at the next meeting, and then maybe hike again. after that if needed. That's what it looks like to me. He's also saying uh, there's there's risks of doing both too much and too little. So they're hedging like completely. That's which is different than what he said in the past, which was always the risk of doing too little is greater basically than the risk of doing too much. But now he's saying doing too much could also do unnecessary harm to the economy. So shows you they're again near the end of the road here with the rate hikes for now, as far as what they're seeing now with the inflation numbers and allegedly going back to 2%, their goal. And so to me, that looks like that's what the market's doing as we speak. They're kind of seeing that as this kind of the nothing really changing materially, in my view, at least.
Yeah. I have a whole I don't know. I guess I have a whole viewpoint about Fed behavior and how they go too far, but maybe I won't belabor that because
Well, they definitely went
I
no,
think,
no, go for
you
it. They
know
definitely went too far not doing
yeah,
anything. Well, they depending what you wanna say, they went too far with the 0 rate
yeah,
and stimulus in
yeah,
2021, like, at least a and I'm not this isn't hindsight. I was saying this at the time, like, it was, like, 6, 9 months, almost a year too long of that, and
yep,
so that's overshooting that way, and now I don't know what they're doing now, but
right,
but they neither do they apparently. They're
no.
just watching these inflation numbers like everybody else and seeing what happens.
Yeah. Yes, exactly right. They're j they're as reactive as all the rest of us,
They're more reactive.
which is funny
I think
because
they're more reactive than
yeah,
people actually trading in the markets every day. Like, they look at old data, like, all the time. They're the last to kind of acknowledge something that's going on, and the market's always, ahead trying to, predict what's gonna happen next, and,
yeah. That's a to be fair, that's an institutional thing, like Wall Street, ratings agencies, big banks, everything. Everybody like, we heard all this stuff about, BlackRock and ESG, and now the headlines a year later are they're backing off from this because, obviously it's a horrible way to allocate capital. Um, and the ratings agencies are now downgrading banks. They weren't doing it a year ago. They weren't doing it before the banks failed. They're doing it now. Now the rates are even higher and the asset values are even lower. So um, yeah, they're all late to the party. I agree. The Fed's late to the party. Wall Street's late to the party. When the Wall Street big banks are shutting down their commodities units, that's the time to buy commodities, right? So it's just par for the course. We'll see. I think that it's sort of like the election. Like overall, nothing fundamentally changes as long as the economy stays like what I would call free and open enough, you know? If as long as it's like free enough and people can trade and do business, and afford to, pay for all the regulations and get around them and do whatever they have to do business, you know, it's still be like it's still a great idea to own great businesses that gush free cash flow and have good balance sheets and the my caveats about holding plenty of cash and plenty of silver and gold. I mean, arguably that's a good idea all the time, right? Not just now. I contend that now it's an even better time, but still I don't see it's funny, isn't it? Like I spend a lot of time and I know you spend some time in the digest too. We spend a lot of time considering big risks that maybe people don't talk about enough. The risk of a sideways market or a bear market, or, the fact that Nvidia is 240 times earnings or something. And that means that we're still in a kind of a mega bubble situation. I feel like I spend a lot of time talking about that. But the truth is, like, those are the outlier events. I'm just trying to bring them into your consciousness because I feel like nobody else is. But the truth is, like, most of the time, just be prudent, buy good companies, hold them for the long term. That's the way to make a lot of money in the stock market is to let the compounding work for 20, 30, 40 years.
yeah, asset allocation. As far as you're saying, yeah, it's always a good time to have cash and gold, as whatever you want to, for whatever reasons you want. That makes sense
Mhm.
to you.
Yep. And I've seen people over the years, and now and then myself included, like, react to um, elections and to, Federal Reserve moves and, financial crises and things. And I've over, I hope I'm done with with overreacting, right? We've continued finding good businesses in the two newsletters that I write. The basic thing is to find good businesses and to, invest prudently for the long haul. That hasn't changed, right? But I spend a fair amount of time here on the podcast and then in the Daily Digest talking about this other stuff, and people think I'm a perma bear. And I'm sure you've been labeled with that once or twice.
Yeah, yeah, I
No?
guess I have, which, yeah, I'm not. I'm
Yeah.
definitely not. If so, I
Yeah,
could say that, yeah.
exactly.
Which might surprise people, which is interesting to me. Like, yeah, we're just talking about the risks and things that absurdities and things that you won't hear elsewhere. Yeah,
And the context too
yeah,
for all of this, um, I guess what we're saying, the context for all of this is always be a prudent investor, invest for the long haul, don't overreact to the headlines. Um, the context feels to most people, I understand, very different from the content, right? But I just feel like the context that I described here, where you should be a prudent investor, et cetera, for the long haul, is very different from the content that I provide and that you provide too. Um, and I guess maybe we need to say this once or twice a year. I don't know.
yeah, yeah, I guess so. Or maybe we need to do a better job, otherwise. But it's, within that context of going back to the politics, to relate this to the political conversation, like, whoever wins, Democrat, Republican, whoever the Republican nominee is, whoever the Democrat one is, like, what's not going to change, right? Is what I like to think about. So what's not going to change?
Mhm.
Defense spending, right? Like, we see all these different, we got the war
Yeah.
in Ukraine, which we've talked about. We have escalating things with China and Taiwan. Those things aren't going away. And if anything, the conflicts with China are going to escalate even more, I fear, in the years ahead. And who knows what that leads to.
Mhm.
Um, so, like, that's looking beyond a headline, short-term headline of what may be happening in the Taiwan Strait or whatever. It's that's not going to change. Is one way to think about how to ignore these type of headlines, or not. We're all emotional. Like, it's easy to be, it's easy to be sucked into whatever is happening any day and forget about long-term returns over time. It's hard to do.
It
That's
is.
one thing I try to do. What won't change? What matters from this, and what doesn't.
Yeah, and don't let Dan and Corey stoke your emotions into making you sell everything and go to cash. Just keep being prudent. Just keep these things in mind. Look around, we're trying to look around corners to see if there's anything big and scary. And most of the time, even if we see something that's a potential problem, like we're saying, the context is always, probably not going to change that much. Stay focused on the long term. Boy, that's a good place to end. Stay focused on the long term. All right, let's talk with our good friend and our colleague and a fellow value investor, Bryan Beach. I love talking with Bryan. It's been a year. It's been a long time since he's been on the show. And he's of the true diehard value crowd. He's one of the smarter folks I know. He digs in deep, deep into these small cap companies, many of which you've never heard of, and does an excellent job of finding some really great undervalued stuff. So let's talk with Bryan Beach. Let's do it right now. NVIDIA may be America's top performing stock after more than doubling this year alone. But if you're holding NVIDIA or thinking of buying it to get a stake in the $7 trillion AI market, you're going to want to see what Mark Chaikin's new AI prediction is first. Mark is a regular on many major news outlets, from Fox Business to CNBC. And he built the stock indicator Wall Street uses to find winning stocks. His award-winning system flashed buy on Tesla before it climbed 335%, Moderna before it climbed 300%, and Riot Blockchain before it climbed 10,090%. It also found NVIDIA at the start of 2023 before its massive bull run. But right now, Mark is stepping forward to warn people to stay away from NVIDIA. My system has indicated that NVIDIA is no longer the best stock to buy to profit from AI, Mark says. In fact, it just flashed buy on a totally different AI stock. And today, he'd like to hand you the name and ticker symbol of his number one AI stock to buy right now. For a limited time, you can get this information for free at www.aifrenzyreport.com. Again, that's www.aifrenzyreport.com for a free copy of his new report. All right, it's time for our interview. Today's guest is my friend and colleague, Bryan Beach. He is the editor of the Stansberry Venture Value newsletter. It's a small cap value newsletter, which I think is really cool. I love small cap value. So, Bryan, welcome back to the show. It's been a while.
It has been a while, Dan. Thanks for having me. Look forward to seeing you again in person soon, but it's good to catch up here on your podcast.
Yeah, I can't remember the last time we were in the same room together.
Yeah, we were at a dinner and you had too much wine. That's probably why you don't remember. But it wasn't that long ago. So
There you go. All right. Well, that explains that. Now everybody knows a little bit more about Dan. I think the best thing that you and I can do is get right into it. We do
okay.
talk about macro things with some guests, but I don't want to waste 1 minute on that with you because your thing is digging in deep to all these little companies and the industries that they're in. And I noticed, I just looked at your last, I don't know, 5, 6, 7 issues, and it seems like there's no industry you won't look at. It seems like you'll look at anything.
Yeah. Yeah. Anywhere where I can find a little value nugget here or there. I prefer operating companies that produce cash flow. But I also, I find special situations here and there. You can scour the market for, basic screening tools sometimes, but often I look at what hedge funds are buying. I look at what other value guys are talking about. And that can be a source of some pretty cool ideas to research further and write up for my file. I've been pretty conservative in 2023. There's been a lot of picks that you might even call income picks. No matter what happens with the market, you get a nice, safe yielding dividend. That's not really how we launched this product back in 2017, thinking about income. But 2023 is a weird year. I don't know what's coming. And so I wanted to just kind of spend a couple of months maybe getting some ballast in the portfolio with income. But yeah, to your point, we'll generally it's operating businesses that are in lots of segments, lots of different sectors.
Right. And I noticed at the beginning of one recent issue, you said you spend all your time looking at beaten down. I forget what the phrase you used, but it was like beaten down small cap companies. But is that what do you look at like 52-week lows and you're looking for everything that's had the crap beat out of it or
That's a
just
good
generally?
starting point. Yeah, I look at 52-week lows. Lots of people, anyone can screen on that. But I also look at hated sectors in general. We've talked about some of those over the years. I think last time we were talking about opportunities in SPACs, which were beaten down and are still beaten down. But there's some pretty good companies in the SPAC world, and it's been interesting to try and find some of those. If you look at my portfolio, I've done okay with that, but there have been some misses as well. So I look at sectors. I also run the screens that everyone else runs, looking at 52-week lows, like you said. But when you're a value guy, that's a really good place to look.
Hey, I'm just curious about one little detail. Like um, when you run screens, what's like the top market cap? Like below what market cap are you calling small cap?
I like to go 3 billion if I'm doing a screen, but almost everything in my portfolio I recommended below 500 million, and some of them significantly less than that. Market cap's not really the big constraining factor for me. It's daily liquidity. And you can have an $80 million company with plenty of liquidity for me to recommend to a file of, thousands of people. What I can't do is if a company's got, $25,000 of daily trading value, I can't recommend that in a newsletter. But market cap's a good starting point, but really, the bigger issue is daily trading liquidity. I really need about $1 million worth of daily trading value to not, disrupt the market with a write up.
Right. So share price times average daily volume is at least 1 million.
Yes. Yep. Exactly.
All right. So let's talk about what you are interested in nowadays, and it's an area that you have a history in, which is software.
Right. Oh yeah. Yeah.
Like this is a deep subject for you. This is an industry you know well from the inside out.
It is, and you brought this up. And we were talking about it beforehand. What sectors are the most beaten down? And if you want to know what sectors are beaten down, look at the hottest sector from 2 years ago, right? At any given time, right? And that's what happened with SPACs when you and I were talking a couple years ago or whatever. And right now, it's software as a service. I'm really finding some interesting companies there. And yeah, to just go back into my background, I'm an accountant. I'm still maintain my CPA designation, but I was a controller at a publicly held software company for years and years, working pretty closely with our good friend and colleague Mike DeBias. I don't know if you knew that we worked together a lot of years in the software industry. And it was funny, Dan. I there back in those days, and I'm talking about kind of the mid 2000s to early 2010 kind of time frame. After I left, I had a consulting company for software companies for a little while to help them. And the big thing right then, Dan, was we would sell perpetual licenses. That's how you sold software. You would sell the software, and so they would get the customer would get a license, and then they would have to buy hardware, and they would have to sign up for an annual maintenance contract, right? I mean, that was the old methodology. So you might sell $1 million worth of software. That's a big deal. And you would have maybe $150,000 of that would be recurring maintenance revenue, support revenue. So that, future upgrades, stuff like that. And then they would probably have to buy $150,000 worth of hardware or $200,000 worth of hardware. So it's a $1.3 million cash outlay for your customers. And what Wall Street wanted at that point for publicly traded companies was to recognize as much revenue as possible up front. And so what Wall Street wanted to see was these big, chunky $1 million orders. So fast forward to really the early 2010s. Mark Benioff at Salesforce.com had transformed the way software is sold. And it's really a better model. That's where software as a service came from. And so what's different about that, Dan, is you're leasing it instead of buying it, just like with a car, right? You can lease or buy. So with that, there's no hardware to buy. You don't pay a separate maintenance contract. They own the license, Salesforce.com owns the license. They'll host it on their servers, and they'll charge you $200,000 a year. I'm making that up. I have no idea what Salesforce charges. It depends on the size of the client. But in my example, instead of $1 million up front for license and then maintenance and services and on top of that and hardware on top of that, there's just one monthly fee. And it took about 10 years, but Wall Street fell in love with the model because the way the math works is there's nothing else to sell 5 years later. You understand? Like under the old way, then we had to constantly, after 5 years, we were in another sales battle, right? And we're trying to sell another $1 million worth of software. So, the Benioff model, the SaaS model, Wall Street immediately fell in love with it. And they realized that after 6 or 7 years, it's much better to be a SaaS company than trying to sell perpetual licenses.
And Bryan, just for our listeners' sake,
Yeah.
SaaS, SaaS, software as a service. That
I'm
is
sorry.
software subscribed to as a service. That's okay. You're good.
Yeah, I should have thrown that out there to begin with. So, but that's leasing. That's the leasing model. SaaS is leasing. the software. Well, Dan, you're a value guy, and through all this time, I was a value investing junkie just on the side, including reading this newsletter called Extreme Value occasionally. I don't know if you knew. I've teased you for years about being a subscriber before we ever met, but yeah, I learned a lot from your stuff, and the Buffett letters and all the things that value guys read. Um, and I was very interested in what was happening in my professional life with these software companies versus what was happening in my kind of hobby, which was, studying value investing. It was just an interesting juxtaposition. And what's happened is, from about 2015 to 2021, Dan, the market fell in love with software as a service, and it became the hottest thing out there. And I had a lot of software in the venture value portfolio because that's where I was comfortable. That's what I understood. And you can describe what happened next, even if you weren't paying attention. It blew all the way up and it came all the way back down. And what's interesting to
Mhm.
me right now with these SaaS valuations is they're kind of creeping back up, which, it is showing that, the favor, it's not hated anymore. It's in, as our friend Steve Sugarwood would say, it's in an uptrend, right? Cheap hated, but in an uptrend, and that's a really interesting sector for me. And it's funny for me personally because I've watched the cycle go all the way around. Wall Street went from hating the idea of subscription based revenue to loving the idea of subscription based revenue. And now they kind of hate it again. And so, here we are. And that's what I'm sifting through right now.
Good. One of the things that you learn about, because you and I, of course, work for Stansberry Research, which is a subscription-based business, and it is wonderful. Subscription-based businesses can be quite wonderful. But one of the things you learn about is that as soon as somebody signs up, speaking of revenue recognition, as soon as somebody signs up and, if their subscription is $100 a year, that even if they start by paying you $100, you're not gonna deliver 12 issues of a newsletter to them in the first month. You're gonna
Right.
deliver 1. You recognize the revenue for 1 because that's all you fulfilled.
Right.
So there's a liability that comes with that subscription, and like, that was something I never thought
Oh
about,
yeah.
ever.
Yeah. Okay. So you're talking about my old job, right? Like I had to make sure that the lawyers were structuring these software contracts in such a way so that the accountants would acknowledge that most of the value is related to this software license that we're delivering right now, that we're emailing you right now. That's what most of the value relates to. It doesn't relate to this maintenance contract that we will be providing you over 12 months. It relates to this. I had to prove to them, we're delivering something right now worth $1 million. And there were ways that you could word the contract to make that more obvious. And if you didn't word it that way, then the accountants just assumed, and I was myself as an accountant, I'm talking about the SEC filing regulations. It would assume that entire contract was tied up for 12 months in the way that you just talked about. So yeah, and if for the accountants out there, if you pay you 100, let's say call it $120 just to make it easy, $120, only $10 of that is revenue up front, and $110, the 11 months you haven't delivered yet, is deferred revenue, which is hung up as a liability. So for a while, Wall Street was scared of thinking about things that way, and then they got enamored with thinking about things that way. It's been interesting to watch.
Right, so let's talk about why they got enamored. Let's talk about you said you don't have that if it's a 5-year contract, you don't have to go through this whole sales cycle again in 5 years. And in fact, if someone has subscribed to your thing for 5 years, that's really good, huh?
Very sticky. We call that stickiness. And a good software company, and this is very easy to measure, will renew 98% of your customers every year. I mean, and it's the same
Wow.
thing. Like, you do this, I do this. Every time I walk in my house, I walk by the ADT security code, the little punch button by my garage door. I'm like, am I still paying $24 a month for that? Like there's just something about subscriptions, and so when you talk about software, we'll talk about Salesforce just because we've already brought it up. We use Salesforce at Stansberry, uh, you've trained everyone up on it. The whole sales team knows how to use it. It's got all of your customers' data in it. It's sticky. Why would we think about not renewing? It's a very powerful business model. So Wall Street, I think they're right. $1 of SaaS revenue really is worth more than $1 of selling widget revenue or selling, number two pencil revenue, because it's gonna come back every year without trying, 95 to 98% of the time. It's a great business model. It's a better way to do it for sure.
Yeah. It's funny. You just said, it's $1 of SaaS revenue is better than $1 of widget revenue or number two pencil revenue. And the first thing that came to my mind was, what about iPhone revenue?
Hmm. Yeah.
Because of course that's a device that has all this other
It's,
stuff attached to it, that has software attached to it.
Yeah, that's software too. But I've not delved into their financials in years. Probably I didn't many years ago. But yeah, and that's something the accountants have to figure out. How much of this revenue relates to the software and how much this revenue relates to the hardware, and that's the reason. It's a revenue timing decision. So. Dan, a really cool case study for this is Adobe. And I believe it was 2014, they went out and they made the transition from the perpetual model to the SaaS model. So they have, of course, PDF is the big product. Also, I think Photoshop, which photographers use. They have all these different software, and they're like, if you want our products, you're going to have to go subscription. And then the CEO had to kind of train the analysts how to think about this. He'd say, look, it's going to look like revenue's not growing, but it's fine. It isn't growing, but it's because we're selling on purpose. We're selling on a subscription basis right now. And that was, I think, 2014. And so it's been about 10 years. And look at what's happened to the cash flow of that company as it just builds up and up and up, because, as you said, the expense base doesn't grow. It's just, the number of subscribers is growing. It's a great model once it's mature, for sure.
Yeah. And it kind of shows you, though, too, as an analyst, you really have to be forward looking with this.
Yeah.
You can't just look at the trailing
Yeah.
financials and kind of extrapolate into the near term future and say, well, that's it. And it's worth,
Yeah.
12 times earnings or something. You'll get it wrong. It really is a long-term proposition, isn't it? A SaaS company.
That's right. And
It's almost like an insurance company or something.
it doesn't look like a good business model for the first 7 years. It really does. It looked and that's why Benioff started this in 2014, or I'm sorry, 2004, or something like that. I might be getting, but it didn't get hot. It didn't become hot until like 2014, like 10 years later. And that's why. I mean, it took 10 years for the market to be like, oh, I get
Yeah.
it.
Yeah.
Oh, okay. And,
Yeah. And
now
by
it's been
then,
another,
billionaires were made from the thing. I mean,
yeah, yeah.
Yeah.
And now it's been another 10 years and it's gone, it's done a full cycle since then. So, I think value guys like you and me it's fun to roll up your sleeves, call some customers. Okay, how sticky is this really? Um, you can pretend to be a competitor, fun stuff like that. I know a lot of software sales guys still, so I can, ask around. They're willing to share war stories, and you get a real sense of how sticky is it really. And it gets even better than stickiness if you can constantly sell your existing customers new products, right? So you could have, renewal rates technically over 100%, right? I mean, if your customers from last year bought $1 million and that same customer list bought $1.1 million this year, sure, some of them probably dropped off, but the ones who remain buying more software offset that. So I'm really starting to roll my sleeves back up in this corner of the market. And any listeners who are into value, you're gonna not like that we're using price to sales, a price-based multiple, but try and look past that. Dan's gonna make fun of us, for using that metric, because that's what he likes to do. But look past that and look at some software stuff.
Well, hopefully, I'm only making fun when it's hit, 20 or 25 times. That's when I really start making fun.
I read your stuff, and you always bring up the internet boom. When price to sales comes up, you bring up and I'm like, well, that's not the only time that multiple is used, that metric is used, and it's kind of a
No, but my point is general. I'm usually talking about like big overall trends. I'm not talking about analysis of individual companies. And I am accusing. I usually am looking at like companies that aren't profitable, that I think are garbage anyway. So if I scoop SaaS companies in with that, maybe you can forgive me or something. But I'm unaware of having written specifically like targeting SaaS companies. To me, like that's too narrow. Like, yeah,
it's stuck in my craw, so you must have at some
yeah,
point. I don't know.
I must have
I
somewhere.
can't cite it, but
Well, no, my big targets have been the components of the ARC Innovation Fund
yeah,
and the various, all the bubbles that were insane in early 2021.
yeah.
SPACs, clean energy, cannabis, all the stuff that even if it was a great business, there was no way
No,
that
that's
that was
true.
the right number.
Yeah, and SaaS did get lumped in with those businesses, and to some extent deservedly so. But um, unlike, say, the internet boom or clean energy, which may or may not work out. I'm not here to dog these clean energy companies as businesses, but there is an established path to huge cash flows for the SaaS model. And you can't say that about, mining for battery material on the ocean floor. Like we've already got a model. We know that the SaaS model can lead to cash flows already. So it to some extent it was fair to scoop those all together, but I always kind of was like, yeah. On the other hand, as a value guy, fine, dog the model, and it'll leave more opportunities for those of us who understand more of the nuances. But you haven't made fun of SaaS in general. I just mean that metric comes under your attack every once in a while. So
Yeah. Yeah, it does. And it's, it's to me, it gets obvious. I like to think the way I'm doing it, it's kind of obvious why, but maybe not.
yeah, I know.
Maybe I'll be more careful about scooping the SaaS up
Be
in there. But
careful, man. That's all I'm asking.
yeah, that's right. And now I'm like, well, let's see. I need to pay more attention to these companies.
Yeah.
It's funny, Brian. I was at a meeting of investors, and the topic of subscription-based businesses came up. And at the time, things were very expensive. So, everybody was like, but it's become more interesting. And SaaS has become a really interesting topic among these folks in the past year or so. And it's a group of value people that I meet with once a year. And, they started asking me about our business. I was like, well, not a software company, right?
Yeah.
Software and my point is that software is a big part of the equation. Like you can't do this with donuts or something. You know what I'm saying? It's like, maybe you could have a subscription donut business, but a subscription software business is like, I mean, the product is so deeply embedded in your life at this point that it's like begging to be a subscription, a sticky subscription, isn't it? Like, that's a big part of this.
It is the most important. Let me give you a single number that just sums up what you said. It's renewal rate. Okay?
Mm, yeah.
That's
Yep.
what you're talking about. A
Yeah.
donut business, a subscription of donuts or a subscription of jellies or whatever is
Yeah.
not going to have a 98% renewal rate. And
No.
frankly, I don't know if I can say this, but neither are newsletters, right? I mean,
Right.
it's not a 98% renewal kind of a business. And it comes down to mathematics. And DBS and I have figured this out, mostly Mike. I think I'm throwing this out there. I say rent, at this leasing software, subscription, SaaS. Leasing software is more profitable, a better business than buying software or selling software, right? But there's a point where that's not true. If your renewal rates dip below, say, 90%,
Right.
the math doesn't work that way, right? You might be better off. And so in your donut example, you're better off just selling donuts by the dozen to people who are hungry right now than to try and get them on the hook at a discounted rate, or I don't understand how to make this a perfect analogy, but
Yeah.
the renewal rate has got to be high for this to work, even with software companies.
Right.
If
Right.
your customers, if it's not sticky, it's not going to work, and that's a pretty easy calculation to get. I mean, the software companies have to disclose it, or they usually disclose it. So that is one number that kind of sums up everything you just said about the types of businesses this would work with.
Yeah, and it's even like it's better the original subscription business, of course, is like periodicals. And it's better than that because you can get tired of Time magazine, or you can get sort of, bored with whatever, plug in the name of any periodical, you can get bored with it. Now, in the days of newspapers, and now newspapers are still that way, but it's an online model, and it's sort of grown up with the times. But my point was that, like, I mean, software, it's almost like, diabetes medicine or something. I mean, you just can't function without it,
Yeah.
especially businesses. And that fascinates me. It fascinates me that there are some product, the matching of a product with a business model. It's quite a beautiful thing, actually, when you.
So you brought up newspapers, and we've been kind of mentioning Warren Buffett in passing. I heard a software value guy named Savneet Singh. This is on a podcast years ago. He was being interviewed, and he, interesting guy. I could talk more about him, but he had a really cool quote, and it sounds like you would agree with him. If Warren Buffett were 24 years old today, he would be all about software, right?
Yes.
The same stuff that got 24-year-old Warren Buffett excited about newspapers back in when he was starting the Buffett partnership in the 50s, and just started buying up every newspaper he could, because of what you're talking about. Like, people just they renew their Buffalo News subscription, and that's one of the first papers he bought. Of course, he ended up buying the Washington Post at some point, and all those things that he loved about newspapers are true for a sticky software company. And so really it should be an area where value guys are interested.
Absolutely. If you're that guy, that sort of, the Buffett thing is like wide moat, can't, addicted to the product. He used to talk about, other consumer products that way too, like Wrigley's chewing gum or Coca-Cola or whatever it was.
Yeah.
And it's the same thing. I find, I guess what I'm really not being very articulate, but I'm trying to say that these things are embedded even more deeply in your consistent sort of consumer delights,
Yeah. Hey, you want a stock pick?
Sure, man. We love stock picks.
So it just came to mind. Actually, it's kind of, Savneet Singh, I just brought him up. So he is a guy who focused, I think he and some buddies, they had all made a ton of money and stuff. His backstory is kind of fun. Young guy, I think he probably just turned 40, but they started a fund, a value-based software fund. And he, is well known in software circles now. But back in 2019, he took the reins of a company that was transitioning to software called PAR Technology. He's the CEO now. He was an investor and then became a CEO. So an interesting thing, this is a company dating back to the late 60s. They sold some kind of technology to the Army, that could detect vibrations in the ground or something to detect tanks in Vietnam. And they've still got this top secret Army component today. They've still got this kind of Defense Department contract. So that's a big part of the business, oddly. But way back in the 70s, they started selling. How can we use this technology? And I don't know how it worked. They started selling hardware into fast food joints. And I think all of the cash registers at McDonald's were sold by this company. And then really they started when Savneet kind of took over. They were about 10 years into starting to sell software into all of their fast food joints, right? That stuff that automate, inventory levels, schedule employees, kitchen times, and process the payment, all of this stuff. So he's cobbling together a little software empire related to restaurants, and this company just keeps growing. I recommended it in May 2020. May 2019. Gosh, 14 years ago or 4 years ago, and it at about probably 26 or 27 bucks. It's probably at 40 bucks today. So it's up 40% over 4 years. There's nothing to brag about at a cocktail party. But what's interesting about this company, Dan, is that it is a perfect exemplar of the valuation stuff we've been talking about. I recommended it at 20 or at 25. It went down to 10 during the pandemic, up to 90 in 2021, from $10 to $90 in 2021. And now it's back down at around 40. So, technically, I think my buy up to price is 38. So I'll probably get in trouble for telling your listeners something different than what my official subscribers are getting in terms of guidance. But keep an eye on it. It's 40 bucks today. It might be, 38 tomorrow, But what a perfect one stock example of what I'm talking about. Now, because there's this non-software component to this company, the valuations don't look like what we're talking about. But I think at its peak, it was like at 10 times revenues. And again, a lot of those revenues are not software related. So they're not, they shouldn't have a software multiple. And now it's probably at less than 4 times revenues. And over this time, when the stock went from 25 to 10 to 90 to 40, it just kept, the revenue just kept growing. It went from 200 million to 400 million, more or less steadily, right? And what is the market doing going from 10 to 90 to 40 when it's just steadily growing? So take a look at this. It's run by a software guy. You'll love this. What do you think Savneet Singh did when the stock hit 90 bucks or 80 bucks or something? What do you think he did as a value guy? What would a value guy running a public company do at that point?
Issue a bunch of shares.
He did. He sold a bunch of shares to the market to fund some acquisitions, to cobble together this conglomerate. They're still not making money because he's buying companies and innovating new products, very long-term view. So I don't know how long it's going to take, but I did not sell this thing when it went from 25 to 10. Obviously I should have clipped some gains when it went from 10 to 90. But I like this company. I may raise the buy up price soon. I haven't yet. But what a perfect example of what we're talking about, and you'll love the guy running it, Dan. He's cut from your cloth, but he's a tech guy.
Okay, I'm going to have to look at this. It calls to mind Constellation Software in Canada, which is a fantastic example of if you were Warren Buffett a little bit later, what would you do? Well, you'd roll up 1 million software companies under one roof.
Yeah, and PAR is focused right now on restaurants, and
Sure.
It was doing fast fast food joints mainly, and it's branching into now table serve, and so they're focused on one area. I think Constellation was just looking for mom and pop software company, it was less.
That's right.
Industry specific, but it's very smart what Singh is doing, because I can just cross sell you this stuff, right? Hey, you're using my payment processing stuff. Why don't you use, my kitchen scheduling, software or whatever,
Yeah.
hey, you've been using our hardware since 1972, right? Like his sales guys have 1 million people to call, right? Because they've already got the hardware in these company in these restaurants. So I can't wait to see what he does. And he's already shown that he's got a value investor's mind selling at 90, and or whatever it was,
Yeah.
80, 75. I mean, um and they should flip to break even this year. That I think that's going to
That's
be a
great.
catalyst for the market, right? That's going to be a,
Yep.
a big catalyst for the market to be like, oh, okay, this is a real business finally, And
Yeah.
I think he's finally on these earnings calls, stop talking like someone who's investing in growth and someone who's kind of ready to cash in on some of these investments. So keep an eye on that one this
Great.
year and heading
All
into
right.
next couple of years. So
All right. PAR, PAR is the ticker symbol. Well, thanks for that, and thanks for being here. I think it's time for my final question, which is the same for every guest. I
oh
hope you
gosh.
don't remember it because it works better that way. And the final question is simply this: if you could leave our listeners with a single thought today, what would it be? And if you've already said it, just repeat it. That's fine.
Well, I think that I assume you're talking about the markets. I a lot of my time and energy has been thinking about what's going on in Europe and the folks over there. Our friend Bill McGilton is still displaced from
Yeah.
Kiev, and uh, you know, it sometimes seems gauche to talk about the markets and think about the markets all day, but what's happening over there is going to have a big ripples for unfortunately I think decades. And I've rambled on about software a lot, but I've got my eye on energy and commodities. I think are going to be um, an area to watch, and you don't need to hear my final thoughts, to know that. Everyone knows that. Um, but I guess my final thought is to not forget about the people like Bill. I mean, it's a tough time to be alive for a lot of people.
Hmm.
And um, I catch myself thinking about oil prices this weekend. I was looking at some oil companies and just thinking about the impact of what's happening in Ukraine and in Russia on grain exports and oil. And, I'm just got this mathematical mind. And I'm just like, gosh, there are people, Bill's kids have not been at their apartment since April of 2022,
Yeah.
and just let's, I try to make myself think about the real life stuff behind some of these market topics we talk about. I don't know. That's probably not what you were looking for, but you don't have to hear it from me. That energy is going to be really interesting to watch over the next couple of years. Obviously, I'm looking at software right now, but let's not forget the people, in Ukraine and Russia too. I mean, thoughts and prayers go out to some kind of resolution to that.
Yeah.
I'm numb to it now, like everyone. It's been a year and a half, but you know, keep keep praying for something better over there.
All right. Actually, that's fine. You said, um, just now that that wasn't what I was looking for. It's exactly what I'm looking for. It doesn't have to be, a stock pick or a Warren Buffett nugget of wisdom.
Yeah.
It has to be something. Well, exactly what you did. It's an authentic thing that you wanted to tell the listeners before we signed off, and that's perfect. Absolutely
No.
perfect.
All
So
right.
thank you for that,
Thank you,
and
Dan.
thanks
I
for
can't
being
wait to
here.
see you. See you in October, right?
Yeah, 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 absolutely. See you in October at Las Vegas at the Stansberry Conference. We'll both be on stage at least once or twice, I guess.
Yeah. All right. Looking forward to it. Thanks again.
All right, thank you. Many mainstream analysts are predicting that stocks will recover soon. But I say we'll instead witness a cash frenzy unlike we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation or any of these other things. As all this unfolds, the financial consequences of what I'm talking about could last for several decades if you don't understand what's happening. There will be winners and losers, and now is the time to decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone for a free copy of this new report. I always enjoy talking with my friend Bryan Beach, and I hope you can see why. He's a font of knowledge. It's fun sometimes, of course, to talk about all of the macro stuff that we talk about, that Corey and I talk about, et cetera, et cetera. But when you find somebody who really knows an industry and a particular company, he mentioned some particular companies here and there really well, let's face it, that as investors, that's what we got to do. You have to know your industries. You have to know your companies. You have to know what things are worth. You have to know when they're exorbitantly expensive at 27 times sales and when they're dirt cheap at 6 times sales, like Bryan talked about with the SaaS companies. And I also found the comment where he said that if Warren Buffett were 24 years old, he would be into software. That instead of newspapers, when he was 24 years old, he was buying newspaper stocks. But if Warren Buffett were 24 years old today, he'd be as excited about software companies as he was about newspapers. So I think that was very insightful, and I think it's spot on, absolutely spot on. And that's, if you're that kind of investor, you're looking for those companies that are, as we talked about during the interview, deeply embedded in our lives, that produce reliable cash flows over the long term, whose financials might not be so sexy right now, as we talked about also. Then, if you didn't already know it and you aren't already there, software is the place to go. Really fun conversation, as usual, with my friend Bryan Beach. So that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com, please. And also, do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @investor_hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call our listener feedback line, 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, until next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.